Good afternoon, everybody. Thank you all for making your way south of the river on a lovely sunny afternoon to come and hear about exciting regulatory matters. For those of you who don't know me, my name is Mark Spires. I'm a partner here at Boville, in particular looking at buy-side firms and non-retail banks. A couple of housekeeping points. We don't expect a fire alarm drill or anything like that, so if it goes off, make your way quickly and quietly to the exits at the front and rear of the cabin. We are also having this session filmed, but it's just us that gets filmed and possibly, I think, the back of your heads or something like that. Just so that you're aware. We will have, hopefully, time for questions and answers at the end of the presentation. We'll try and leave some time for that, but we will be here after the presentation. So what are we looking at today? We're looking at product governance. We've had a few sessions on product governance, and what we wanted to do was really build on those. And this time we're going to be looking at it in I suppose, a value chain perspective, looking at it from the manufacturers through the distributors and then down to the end client, of course, for whom we do all these things. We're going to have a brief recap of what MiFID II brought in and the prod rules, and that will be presented by Sweni Nagda, one of our consultants who works in our investments team and has been doing lots of work in this area. And then we're going to be turning our attention to the customer and bringing the customer's voice into the discussion. And for that, we are joined by our friends, the Wisdom Council, and in particular Dawn Hyams, who will be speaking to you about customers' understanding of what you're telling them and how you might go about trying to bring their voice into your product design and product governance process. And along the way, I'll also pop back up and tell you about a few developments that have happened in this area over the last few months, those beginning and ending with Woodford and Income Fund and all that kind of stuff, and some of the issues that have come out around that. But without further ado, I'd like to ask Sweni to come up and talk to us about the product governance process.
Thanks, Mark. Hi everyone. So as Mark mentioned, I'll give you a recap of the product governance rules for manufacturers and distributors. And I thought skipping a few slides, I thought a good place to start was to talk about the product life cycle. Now, there are many different ways to explain the product life cycle, but most will include the boxes that you see up there in the diagram. They are a revolving circle, as the idea is that this process is continually reviewed and is not just kept, done as a one-off event and left. The cycle that you see is illustrative of the controls that are needed at each step. So we've got product development through to termination, and it's not designed to be an exhaustive list of controls, but indicates a basic approach for firms to follow. Pivotal to all of this, of course, is to have effective governance arrangements in place. And I've tried to highlight this with the smaller circles that you see in the diagram. This is needed for appropriate oversight, committees and escalation points that go direct to senior management. The main point, though, is that the FCA is all over this. This is nothing new. They've made it clear to firms that for the last 8 or 9 years, they expect you to address all parts of the product lifecycle process in your product governance arrangements. If you're a firm that manufactures, then you'll need to evidence that you're testing your products, not just at launch, but continually thereafter, to identify any product features that may cause consumer detriment. And that's just the first step. You'll then need to evidence that when the risk emerges, you're taking mitigating actions in order to mitigate those risks and come up with solutions. The most important thing to bear in mind here is that the FCA has the power to intervene should it wish to do so where it thinks there are significant risks that pose harm to end investors. And the ways in which the FCA would use its powers to intervene include restricting the use of certain product features, for example, restricting the promotion of products to certain consumer groups, and requiring a product to be removed from the marketplace entirely. They exercised this power recently when they restricted the sale of contracts for difference to retail clients. And just last week, actually, we saw that they finalised rules restricting CFDs and CFD-like options and their use to prevent them from being missold and distributed to certain retail clients. So whether you're a firm that manufactures or distributes, you shouldn't underestimate the importance of understanding the product life cycle, as is shown on the diagram there. And that will then help you in your consideration of whether you're manufacturing products, marketing, selling or administering products. You'll also need to evidence how you've developed your product strategy. This is likely to include evidencing who your target market is, the rationale for the products being sold, why the method of distribution is appropriate, and lastly, the systems and controls you have in place to ensure that the product is meeting the desired objectives. So I think this brings me nicely on to recapping the product governance requirements. I've put up on the screen there the requirements for manufacturers and distributors. Manufacturers, of course, in pink and distributors in blue. And the first thing to say is that there are similarities between the two. For example, box 1, identifying the target market. As you'll probably know, both manufacturers and distributors need to identify the target market. If you're a manufacturer, then your aim should be to ensure that each product is designed based on the characteristics and the needs of the end client, that you clearly document this and that there is no room for confusion, so you make it very clear who your end investor is. Likewise, for the distributor, you have an obligation to identify the target market. Of course, you could use information provided by the manufacturer. There's nothing stopping you from doing so, but you also will have needed to do the analysis to determine who your target market is. Boxes 4 and 5 there you'll see are identical for both, so compliance monitoring and developing the compliance report to management. For both the manufacturer and the distributor, the rules require the Chief Compliance Officer to monitor the firm's product governance arrangements and report to the board. We typically see firms carry this out by doing annual compliance monitoring reviews and preparing some sort of exceptions report that goes to the board for its attention. Okay, looking at some of the other requirements, box 3 for manufacturers in pink is to check for conflicts of interest. So the rules require the manufacturer to have evaluated conflicts of interest before issuing a product. Clearly, the interest is in ensuring the product doesn't create a situation where the firm places its interest ahead of its clients. And this is quite topical at the moment, given cases such as the Woodford Equity Income Fund that Mark mentioned before, and he'll be talking to you about this in more detail shortly. So the key here is to always think about the end investor and to ensure that the design of each product doesn't adversely affect end clients. With this in mind, the rules require the firm to have a conflicts of interest procedure covering product development, and also to ensure that conflicts are identified, managed and analysed well before the product is launched. And finally, I wanted to touch upon box 3 for distributors there in blue, which is to provide the manufacturer with data on sales and post-sale review. So clearly there's a requirement for the distributor to do so, and equally there's a requirement for the manufacturer to ask for this information of the distributor so that each can satisfy their own obligations. What we've typically been seeing to date from talking to our clients is that perhaps that information flow isn't as forthcoming as our clients expected, and we're not seeing as many requests between the manufacturer and distributor as expected, given that we're now a year and a half post MiFID II. We're also seeing instances of manufacturers sending requests to distributors that go above the rules in some cases, and they're simply not, they don't need that level of information. So we've had a few of our clients actually only give the information that they think the manufacturer needs in relation to sales and complaints and so forth, and not give that additional information. Okay, I thought I'd pause for a second briefly to talk about the target market assessment, but in particular relation to distributor considerations. So if you're a distributor, then we think it's important you're able to answer the two questions that you see there in the bubbles, which focus on checking whether your clients are in the right service that best meets their needs. So are your clients still receiving the right service? Well, the rules require you to review whether your products and services are best suited for your clients' needs. What we typically see is firms that are distributing focus on products as opposed to services, but it's really crucial that you also look at your services and analyse whether they're best suited for your clients, as well as looking at your products. Are you reviewing whether all your clients are in the right service, both existing and new? So the rules don't distinguish between existing and new clients, so it's important that you remember that you need to look at all your clients. We typically see firms focus on new clients that they are providing a service to, as opposed to look at their existing client base. If you find that your clients are not in the right service that they should be according to their needs and objectives, then you'll need to take some action to rectify this. All too often we see that clients are shoehorned into something that doesn't really fit. For example, if you're a traditional wealth management firm, then you may well offer a number of services. These could include bespoke discretionary management, an advisory managed service, a managed portfolio service, and so forth. Well, if you've clearly defined your client segments based on their characteristics and needs, then it should be possible and fairly easy, we should hope, to identify any instances of clients not receiving the right service. So how could you test this? Well, we think there are two fairly simple ways to test whether your clients are in the right service. The first way is through the annual product governance review. So you could use the annual review to ensure that you review all your products and your services, and if there are any updates you need to make to your target market assessments off the back of those reviews, then you can do so. You should also review MI that tells you how many clients appear to be outside of the target market, i.e. the negative target market. And if you identify any issues, then you'll need to make changes either to existing controls or I should say create new controls. The second way is through first and second line testing of the effectiveness of your ongoing suitability reviews for existing clients. So when your advisors and investment managers are reviewing an existing client's objectives and financial circumstances, they should also be considering whether their clients are in the best service to meet their ongoing needs. For example, is an advisory managed service still right for a client who rarely accepts investment recommendations? Or why is a client whose portfolio has shrunk to £50,000 invested in a few collectives still in the bespoke discretionary service? So really you need to evidence on the client files that your advisors are reviewing whether clients are still in the right service, and where appropriate, are they recommending a change of service? Are you ready for the FCA's review? Hopefully many of you will be aware that the FCA is carrying out a supervisory review on product governance this year. While the scope of this review is not yet known, the FCA will clearly look for evidence that your product governance arrangements are robust and you're taking product governance seriously. So with that in mind, we've spoken to some of our clients and we're doing work with some of our clients on understanding what their product governance arrangements are and helping them to either introduce new controls or to enhance existing controls. And we've set out a couple of questions that our clients have also been considering that I thought might be useful for you to review as well for your firms. Have you identified the target market for your products and or services? Hopefully this is a resounding yes. Have you set up a process to enable effective information sharing with a manufacturer or distributor, depending on the type of firm you are, of your products and or services? And have you reviewed and do you continue to review your products and services? Thinking about product governance in the context of your firm's governance arrangements more widely, it's worth also highlighting that it's important that you consider and are clear on the governance arrangements around who's responsible for the day-to-day oversight of product governance. We tend to see that the board delegates this to either an individual or a committee and receives MI to enable it to effectively control the product governance arrangements of the firm. Have you agreed a person responsible for approving and reviewing your target market assessments? And crucially, from an SMCR perspective, who's the SMF that's ultimately responsible for product governance? Hopefully many of you have already decided who that person is or are in the process of having discussions to decide before the December SMCR deadline. With that in mind, I'm going to hand over to Mark to talk about some recent events that suggest product governance may not be as effective as required.
So just before turning to the eponymous recent events, I'm just going to cover what should be on a lot of your agendas for the next month. If you're a manufacturer, certainly, and to be aware of if you're a distributor. And that's the fair value assessment in funds, the first of which is due next month in August. This is one of the outcomes of the FCA's asset management market review. They found during that review that there was relatively weak price relatively weak competition in their view, and they had concerns over pricing. So one of the measures that they're requiring you as manufacturers to do is to make an assessment annually whether the charges taken from your fund are justified in the context, the overall context of the value provided by your fund. Now, in our view, for that to be effective, you need to bring this into your product governance life cycle. You need to consider it pre-launch and obviously post-launch as well. Value for money has a lot of relevance to various parts of the product life cycle that we've been talking about there, and the elements that Sweni highlighted. So including in that identifying the target market, setting your distribution strategy to reach that target market, scenario analysis to think about the risks of poor outcomes for your end client. All of that kind of stuff needs to be sort of brought within this fair value assessment. So what does the FCA think that you should be considering when looking at value? They've come up with seven areas to look at. Firstly, the quality of service. Interesting. The range and quality of the services that you provide to investors. Secondly, very important, obviously, fund performance. And you should consider that over an appropriate timescale. So, you know, don't cherry pick the last year because it was fantastic, or the year before last because it was fantastic. But obviously look at an appropriate time horizon. If the time horizon for the fund is 5 to 7 years, that would be an appropriate time horizon. Thinking about economies of scale and your own costs. Are they appropriate? Does the client benefit from economies of scale? You know, in this, it kind of is a bit nicer to the larger guys than the smaller guys, this particular one, but you can say no, they get an advantage on pricing or what have you from our size. You need to think about comparable market rates and services out there, and what you think the value of yours are, and you need to consider the classes of units that clients and investors are in. Surprisingly, there was some recent research that said that there are 30% of investors roughly still in pre-RDR units that are paying trail. And obviously, this is one of the things that the FCA wants to change. So that's August's little joy before going on holiday. Hopefully, those of you that are affected are in good place to do it. If you're a distributor, obviously you're going to want to consume these and sort of bring those into your product governance process when you're assessing various funds. Right, on to the fun bit, the Woodford bit. Really, for those of you who've been on some sort of Brexit-induced media lockdown, Woodford is one of several funds, or the Woodford Equity Income Fund is one of several funds that have had redemption suspended over the last few months. They're not the only ones. If you have a look, there are some other ones that have been suspended as well, but this is the one that's really hit the news. And obviously Andrew Bailey has been talking to various select committees and the media and what have you about what the FCA has done, hasn't done, will do, etc., etc. To Sweny's point, obviously this has punted product governance up the FCA's priorities quite considerably. Essentially, the sort of lessons we think to be learned are make a regular assessment of funds. Don't just pop them on the shelf and forget about them. Things change, events happen, and there's drift over time within strategies. So have your product shelf regularly reviewed. We were talking this morning about the target market for this fund and the time horizon. If you look on the website now, it's all lovely and tidied up, and it says, if you want to invest in this fund, the target market is X, the time horizon is X. If you need instant liquidity, this fund is probably not for you. I think we had a little discussion about whether the KID actually reflected that or reflects that now. We're not quite sure. So they've done a little bit of tidying up. But now it's fairly, unequivocal, certainly on the website, that you shouldn't invest in it. That is a negative target market if you need instant liquidity. Beware of pick lists. So those of you who run platforms or do EO business will be aware of this. Obviously, there was a large Bristol-based firm that had a top 50 list of funds. I look at this in the same sort of way as the credit rating agencies. There will be some sort of regulatory action on this at some point, in whatever time scale, in whatever way they choose to do it. Everything from good practice, bad practice type guide, or maybe even actual regulation coming down the track. And obviously, the key thing here is making sure that your internal strategy and the pick lists they have some coherence. So in this case, the internal strategy said sell, and it was still on the top sort of pick list. So that was a bit bizarre. We also mentioned conflicts. And in particular, I'd suggest keep an eye on the gifts and entertainments register for your fund suppliers. It's a really easy place to beat people up if they've been down to Cannes on a research trip or one of those lovely conferences that seem to happen not in Wolverhampton but down in Cannes. So I would encourage you to think about that and any other links that you might have with manufacturers, and if you are a manufacturer, obviously your distributors, shared directors, non-execs, that sort of thing, all things to consider. So I said that what we were doing here was really trying to take a whole value chain look, and it wouldn't really be a Boval Investments presentation if we didn't talk about suitability. So the way that we look at this is product governance is your strategic piece which says, right, what products have we got on the shelf, and what generically are they going to be appropriate for which part of our client base. And then obviously you have the tactical client by client decision, time by time decision of whether this particular product is suitable for this particular client at this particular time. And again, you need to ensure that you have a level of consistency between your product governance process and that suitability process, and they do sort of act hand in glove. We see sort of situations where the two have, for whatever reason, diverged, and that clearly gives you a bit of a problem over time. And that's a really great place to stop and think about the client, and bringing the client's voice into your product governance process. So I'd like to welcome up Dawn, who'll talk to us a little bit more about doing that when I switch presentations, of course.
Thank you. Thank you very much, Mark. Welcome. I'm very aware that I am now the one thing between you and the bar, so I'll try not to make this too long. And it has been a long day. So, product governance, bringing the customer into the room. First of all, referring back to our esteemed leader at the FCA, Mr. Bailey, who I think summed it up really, and it's quite a neat introduction into what I'm planning to talk about this evening, and that's really to say that from his perspective, the effectiveness of communication with consumers is a test of culture. One of the many C words that gets bandied around. But I think when you look at RPPD, PROD, MiFID II, all the stuff that's come out of the asset management market study, there's obviously a desire to try and shift culture in the industry from what's perceived to be a very product-centric business to something that genuinely puts customers at the heart of decision making. And so I think really when you're looking at customers and bringing customers into that conversation, you look outside finance. Every industry would always think about the customer at the end of their value chain as part of their development process. It's kind of embedded ingrained in the way that they think about new products and services. In the investment industry, less so. I think there are other C words that I would throw out at this point in time. Conduct, the transition from the FSA to the FCA ushered in a new era of the regulator acting as customer champion, and we've very much seen that come through in the way that they've acted. Commerciality, actually knowing your customers, understanding their needs, understanding their characteristics is genuinely commercially valuable. And I think the more that firms embrace this, the more they'll realise that. And finally, it's just common sense. Kind of wanting to understand who your client is part and parcel of how you should be doing business. So there are two specific angles that I'm going to cover off this evening. Bringing the customer into the product life cycle, referring back to what Sony talked about earlier, and communicating with customers in a language they understand. That's very much the regulator's phrase, but certainly something that we would concur with. So how well do you know your customers? Now I know that in the wealth management space you will feel that you are much closer to your customers. If you have a direct business, you'll feel you're much closer to your customers. What I would ask is, how well do your senior managers know your customers? Very often they're experiencing customers through some kind of filter or lens or kind of sanitized reporting that goes up to board level. How well do you as a complete business know your customers? And obviously under SMCR, it's not just the senior team that have to worry about that. Everybody in the business needs to have customers, genuinely put customers' interests first. When we talk to customers, which we do on a regular basis, most of them have never heard of you. There are very few investment brands that have any name recognition or awareness. Obviously, they will know the platform that they use or the advisor that they use, but investment brands really, really don't register. When we talk to them about the way that you as an industry communicate with them, and this comes at a distributor as well as manufacturer level. We hear time and time again the phrase Weasley words. We don't really understand what you're getting at, and you just seem to be dodging responsibility. And that brings me on to my other point, the trust issue. Post credit crunch, there is still a major issue with trust in the financial services industry more generally, and very specifically with asset management. It's about trust for me. Before it was implied, now it must be earned. And if you talk to millennials, they've never worked in a pre-credit crunch world. You talk to Generation X, and most of them know someone who's missold a pension. You talk to baby boomers, and a lot of them were at the wrong end of endowment mis-selling. So it's no real surprise that trust continues to be an issue. So what can you do to try and help to overcome that? Customer conversations genuinely add value across the product life cycle. And it doesn't matter where you drop them in, frankly, but the sooner the better. So understanding customer need, actually in any other industry, that is fundamental. That you would never embark on a project before understanding what need your product is going to meet. And actually in the work that we do, we find that more and more is a kind of start point for firms, rather than bringing them in right at the end as a sense check or hate to use the phrase tick box exercise. You know, people are genuinely bringing customers in earlier in the design process. And understanding whether or not the way you describe your products and services resonates, not just with end investors, but with your other intermediaries and distributors. Understanding your service proposition, how are you articulating it? And sometimes you can actually help your distributors if you understand what their end clients are looking for in a product. Jargon busting, we do a lot of work in this space, and I'll touch on some of that in a second. And you know, don't forget to use your customers as a source for your newly appointed INEDs. You know, they may not be from the world of finance. They may not be familiar with your customer base. And they've got they have a very specific responsibility to represent your customers and investors' interests. So how would you do that? All sorts of traditional research tools that we throw at finding out what customers think. But a genuinely meaningful way of talking to customers is to maintain an ongoing dialogue, either through building client councils, if you have the kind of size and scale of business that warrants it. If you're undergoing some kind of major change management program, you might think about a pop-up community. For other clients who have a kind of smaller client base or very specialist needs, something like a customer advisory board or client advisory board can actually be a really useful sounding board for the business as a whole. And once you start talking to that group of clients, and remembering that we're in an age that embraces stewardship, that embraces kind of social impact, actually people genuinely want to get involved in some of this. Particularly people who are proponents of the industry genuinely feel that they have something to bring and that they want to help in the kind of wider societal issues around savings gap and advice gap. Actually, you find that people are genuinely happy to give up their time. Having that kind of ongoing dialogue, talking to them, feeding back what you've done and what you've changed as a result of the conversation and their input can be a really powerful strategic tool for the business. Let's take one case in point that Mark alluded to earlier. The thorny issue of value assessment. Why not find out what your customer's take is on value? There are a lot of metrics, a lot of benchmarking work that's going on some of the hard number crunching, people thinking about actually what's the most appropriate measure of performance. But for us, there are some of the softer factors, particularly in that kind of customer service element that's listed by the FCA, that are actually quite hard to put a number on. And without talking to your end investors and customers, how do you know what they genuinely value? How do you know what they perceive as value in the services or products that you're delivering? So actually getting a bunch of them literally in the room and talking to them. And when I say talking to them, there's a snapshot at the top of a genuinely co-creative session where we talked to customers about their goals, ambitions, challenges, barriers, what they found hard about getting to grips with the industry. And then you kind of use that as a basis to lead them into slightly more technical and nuanced conversations. But there's nothing more powerful than getting a bunch of customers in a room with your senior team, with people who are stakeholders or decision makers. You don't have those regulatory constraints because you're conducting research. And it's a really, really powerful tool to spread some of that cultural change that you need in the organisation. You ask them, why do they invest? How do they buy? How do they select funds? What matters to them? How do they evaluate whether or not the fund outcome has met their expectations? And here I would really also flag that from our perspective, actually how you articulate your objectives and investment policy at the start of the process is absolutely key in assessing whether or not you're delivering value. Because if your customers don't understand what outcome to expect or how that fund is going to behave when you sell it to them, it's very hard to then assess whether or not they've had value out of the process at the other end. Where does consideration of fees sit on that continuum, and how would they improve what the industry delivers? We did some work with the Investment Association. I'm going to share a snapshot of some of the stats that came out of that. Unsurprisingly, the main reason why people invest is for growth. Achieving growth on their investment. And by that they mean growth in absolute terms, by the way. No customer has ever invested on a relative basis. We confuse the hell out of them by talking about absolute returns. What else might they think about? Beating cash, number one. As they age, they might think about inflation. Sometimes they might think about the wider stock market, and occasionally about the peer group. But it's actually pure and simply growth. And increasingly, that's regardless of age group, because even as you move up the age curve, you're still trying to accumulate, knowing that there could be a care home waiting around the corner for you, just to cheer you up on a Wednesday evening. What do they want to know before they invest? They want to know how much risk you are going to take with their money. That's the number one overriding concern, and that's regardless of whether or not they take advice, or whether they're an execution-only investor, whether they're investing in funds or directly or through wrappers. They want to know what risk you're going to put attached to their money. Now, partly because we as an industry have been telling them that's quite important, and partly because they're used to being assessed on an individual basis for their attitude to risk, but absolutely risk is right up there. Yes, they care about the management fees, more so if they're an execution-only investor. They're far more price sensitive. Yes, they care about past performance. Very often, that past performance piece is less about the value that you're delivering in their portfolio, but what they want to look at is the chart to understand what kind of journey they're going to go on. They want to see how much wiggle is in the past performance, and that's more that they're using it more for that. There's kind of an assumption that over time you're going to grow their money. They just want to see how rocky the road is going to be on the way. So when they come to assess whether or not you've delivered value, what are they looking for? Yes, obviously net returns, but the kind of things, the kind of criteria that they will care about are actually, what did you tell them that you were going to deliver against benchmark? What's the fund's target where you have disclosed one? Obviously, we're likely to see a few more of those given the changes to benchmark disclosures under the Asset Management Market Study. How does the fund manager monitor the level of risk in the fund? Particularly pertinent at the moment. The market index that the manager uses as a benchmark, the average performance of competitor funds, and also how the fund manager is remunerated. These, particularly the sophisticated investors, want to know that if a fund significantly underperforms for a length of time, the Porsche is going back to the garage. And that's a quote, unquote, from a focus group that we ran. So these are the kinds of things that investors are worrying about when they evaluate your performance. Looking at the customer service angle in more detail, and slightly ironically, the print on this slide is tiny, but the first two words say clear communications. Clear communications and updates from the fund management group on how my fund is doing. And we very specifically asked about the kinds of factors that we would see forming part of your customer service offering. So, online access, apps, being able to pick up the phone to people, the one overriding thing for whether or not you're advised or an execution-only investor, and bearing in mind that the second one down there actually says don't know enough to say. Actually, if you strip that out, the communication piece is even more compelling. They just want you to they just want to be kept informed of what you're doing with their money. That's really how they articulate it. And I appreciate that that's for the kind of quant researchers in the audience. That's a relatively small sample size, but it absolutely reflects other conversations that we have. So, talking about communication, talking to customers in a language they understand, and that's lifted from the FCA's kind of diktats in this area. How do we know what language the customers are going to understand? What is jargon? Everybody talks about banning jargon, but I think jargon is very subjective. If you look at the definitions of jargon in the dictionary, that first definition, specialised language concerned with a particular subject, feels very much how we think about industry jargon. It's just a peer-to-peer conversation, expert to expert. It's stuff that we are used to reading and understanding in our everyday lives. You ask an end investor or a retail investor or an advisor, it doesn't matter whether they're advised end, if they use an advisor, they probably know even less. That's why they've gone to an advisor in the first place. They would say very, very much the second definition would resonate, which is language characterised by pretentious vocabulary or meaning. And really that's where this kind of gobbledygook Weasley words thing comes in. They just feel blinded by information. And the challenge with that is that they very often feel that you're hiding something behind that wall of words. And it comes back to this kind of trust piece. If they trusted the industry more explicitly, then actually they would be less worried about what you're hiding behind in things like kid documentation, which they just see as a raft of T's and C's and never read, sadly. In terms of some of the next bits that I'm going to share, they're part of a bank of customer insight work that was done for the Investment Association and which informed the fund communication guidance, which they issued, I think it was in February. This actually represented an action that the Investment Association took from the FCA's Objectives Working Group. And it was very much about trying to instill a different industry mindset when it came to communicating with end investors around funds. It's not an attempt at building a glossary. Just from a practical perspective, trying to get nearly 200 individual firms to agree the same glossary was just a step too far. I think it would probably take us, well beyond Brexit anyway. And so really the fund communications guidance is literally that. It's some kind of principles-based rules and ideas for the kinds of things that you should be looking out for that investors may not understand. And this is the challenge. 75% of investors, and we spoke to a sample of 1,000, say that they sometimes struggle with investment jargon. If you think from there that only 25% have said they don't struggle with investment jargon, when you look at the right-hand number, half of people who are investing, 50% of the people who are investing even though they don't really understand what they're buying, which is a bit of a worrying fact, frankly. And this is the reason why they don't understand. We use investment terminology like confetti that they genuinely struggle with. We tested a number of terms through word games and association and in workshops that we ran around the country, actually, so from a national sample. We slightly cheekily threw in bottom up, top down, just to see what funny answers we would get. But genuinely, I think the more concerning stuff is the fact that investors do not get what we mean by passive versus active. When they hand their money over, they expect us to do something with it. That's active management as far as they're concerned. And I think the way to think about some of these is that if you flip it round the other way and said it was inactive management, why would they pay you to do it? So I think passive active is a real challenge, and I appreciate that that's a specific challenge for those of you who are worried about the ESMA guidelines around articulating benchmarks and objectives as well. Hedging, people either get it or they don't, and they certainly don't really understand the investment context. absolute return, just don't get me started on that one. No investor ever understood that the industry was investing their money on a relative basis relative to an index. And then we tried to understand this newfangled thing called absolute return when they'd been investing on an absolute basis ad infinitum. They'd never moved away from cash plus. So we've kind of tied ourselves in knots trying to explain something to end investors that they kind of instinctively understood. But we're stuck with it now. Share class is another one. People often don't understand that a fund is a corporate structure. And that the language that comes with that is really quite confusing. And if you talk to them about a retail share class, they think you've invested in shops on their behalf. They just don't get the way we use these words. Again, income, return, growth, yield, words that you will find in every KID. Growth is slightly better understood, but I think that the challenge around what you really mean in the context you're using it, what do you genuinely mean by return? And yield is another challenging one. Most end investors, if you ask them to articulate yield, will describe total return. That's a particular challenge if you're an income fund that has an objective that talks about, for example, delivering a yield of 110% of the FTSE All-Share, because what they think you're going to give them is 10% total return over the index every year, however unrealistic that might be. Platform, equities, currency exposure kind of get there. And interestingly, volatility. They don't understand the maths behind it, but they get the concept, because volatile means something outside finance, and it kind of means the same thing. So they do understand that it's about the ups and downs and the wiggle. Ethical investment is something that I think a few years ago would have been there'd have been less awareness around it. And I'll come on to talk about long-term and medium-term in a little bit more detail. And I think this is important for a number of reasons. Firstly, when you're looking at your value assessment, you've got to think about that time horizon. How long are you giving a fund to deliver what you've told customers it's going to deliver? It's also in your objectives. And one of the challenges that came out of the Fund Objectives Working Group from the FCA was, okay guys, you're being very vague in your objectives. You know, what is this word predominantly or primarily? These are the Weasley words that people will throw back at you. What do you actually mean? Because it all feels as though there's some kind of get out behind the use of that woolly term. In the case of long term and medium term, it is highly subjective. And you might think that actually the millennials who are going to have a very short attention span and time horizon, but if anything, the opposite is the case. So as when I was a millennial, actually your time horizon is almost infinite, or it certainly feels like it until you get to retire. You know, your time horizon shrinks as you age, and that's as true of investors as it is of the rest of life, unfortunately. Most end investors will use, on average, an 11-year time period to look at and judge performance. Or they'll tell us that they do, but genuinely they will stick with an underperforming fund for quite a long time before they decide to give in. 12 years for an advised investor, so they're obviously being well advised, and 8 years for an execution only. But even medium term is 7 years. And I think we have this kind of perception that actually, you know, all the investors out there, particularly on the execution only platforms, are probably day traders in disguise. But actually, that kind of long-term investing, that message has really got across to people. So I think it's really important that you think, what does that actually mean for your own customer base? So that's really just a kind of a dip, I guess, into some of the things, some of the challenges that we see on a regular basis. I guess coming back to my initial point about culture, for us it really does feel as though there needs to be a cultural shift. You'll find the Investment Association senior team talking about changing mindset, trying to genuinely put the customer at the heart of what's happening. That's what SMCR is all about. That's what the move to having genuinely independent NEDs on boards is all about. It's about putting the customer in the middle of the way that you think about your business. And actually, that can be quite a commercially savvy thing to do. You know, the better you know your customers, the better you can understand your target market, think about your distribution strategy and articulate it more clearly. Putting customers' interests at the heart of business is just common sense. Remember whose money you're running. We get this time and time again. People feel as very disconnected from the industry. They don't really understand the role of investment and asset management in moving capital around the economy. They don't understand that at all. And that once they do start to grasp that, they find it fascinating. Step outside your comfort zone. You know, go and talk to some real people. It's very hard in this kind of regulatory environment to do that, but it's not impossible. And to talk to customers, not at customers, but talk to them in their language. Understand what it is they do and don't understand about how you are trying to communicate what you want, what you're trying to do for them. Thank you very much. Back to Mark.
Thank you, Dawn. So that's the sort of the end of the talking at you. And I'd like to invite any questions for myself, Sweni or Dawn. I think we've got time for a couple, if anybody has any. No, the bar is calling. Oh, yes, sir.
With regards to Woodford and similar situations, do you think there's going to be a movement away from high-profile fund managers into other industries or robots?
Okay, so the question there was, in the light of Woodford, do we think essentially people will move away from the high-profile managers to robots and other solutions, index-linked? Dawn, do you think consumers, have they spoken to you about this? I think it's more for you than a sort of regulatory question.
No, that's fine. It's an interesting one actually, because when this blew up, we actually asked our community of investors whether any of them held Woodford funds, and if they did, whether or not they were aware that they might not be able to get their money out of the fund, and most of them weren't, sadly. There were a lot of people who had sold a few months ago and were feeling quite relieved. Do I think... I don't know. This has happened before and I'm sure it will happen again, regardless of what, you know, human nature doesn't change, even though the regulatory environment does. I think we've already seen a huge growth in use of passives and ETFs. 3 years ago, if you'd spoken to execution-only investors, very few of them would have held ETFs in their portfolios. Now, the really sophisticated ones, that's pretty much all they have. But I think there will still be room for that active management piece. And if you think that passive is the way forward, from an investor perspective, I guess there's an assumption there that A, that they're price sensitive, which they're generally not, and B, that they kind of understand the difference between active and passive in the first place. So I think a lot of that is going to be, when you think that 80% of the industry is still intermediated in terms of fund flows and sales, actually it's kind of down to some of you guys. You know, will wealth managers move away from staff fund managers? Actually, when you start to understand some of the background and what's happening behind the scenes, perhaps it's more about the way people do due diligence on those kind of funds. Perhaps, as we've been saying, it's more around the governance that sits around them. I don't think that they'll disappear completely, would be my view. And Woodford, I think Woodford was a bit of a special case. He's one of the few fund managers that most end investors who read the money pages could genuinely name on an individual basis. And if you look at some of the other investment houses, they've moved away from that culture anyway. And maybe the cultural shift that the industry is going through, we'll see fewer of them being promoted in the first place. But I don't know whether that hasn't really answered your question. But I think, you know, a lot of investors were aware of Woodford. A lot of them did move from Invesco to follow him. For me, some of that is about how that fund was promoted when he first set up on his own, and I'm sure the regulator will be asking some questions about that as well. And as we say, you know, the buy list piece is again is interesting. End investors value those kinds of things because there is a vast universe of funds out there, and unless they know exactly how to filter what they're looking at, I think there are something like 3,500 funds in the UK fund universe. And how is somebody supposed to navigate their way through that without some kind of shortlist or screening? Or yes, the buy lists are. I guess it depends on what your methodology is behind the buy lists. I think, like a lot of things in the industry, it's not the buy lists are intrinsically bad. It's how you build those buy lists. So.
Okay, thank you.
Okay.
So I think we'll if you want to ask us other questions, we'll be here, doubtless having some sort of drink. Please do join us. We have a couple of events coming up next week. We have a morning Decot session on Wednesday next week. Details are on the website. We'll be at Decot. It's on Senior Managers Certification Regime. If you've not already heard enough about that, I'm sure there are still places. Our next briefing is likely to be on ESG after the summer. So this is our sort of last proper briefing before August. You also have feedback forms in your pack. It would be really great if you could fill those out, especially the bit about what you would like to hear more about or next, so that we can keep our events sort of relevant to what you guys want to listen to. But otherwise, thank you very much indeed, and safe journey home.